The next topic we're going to discuss is on financial statement ratios. Now I'm going to include a copy of this handout that you see in front of you in Blackboard, so you have this. And in this video I'm not going to discuss every single ratio, but I'm going to touch on some of the more common ones and ones from some of the different categories. The first one we'll look at is the current ratio. We've seen this one before. Again, the current ratio and a lot of the ratios, or all the ratios in this category, are going to fall under the classification of a company's short-term debt paying ability, or some of these measure various efficiencies of the company. So your current ratio is going to be measured as your current assets divided by your current liabilities. So you need to find those numbers on your balance sheet. In general, again, this will tell us a firm's short-term debt paying ability, and this ratio will come up with a number. Generally, the higher the better, and companies like to see their current ratio at 2.0 or higher. But with any of these ratios, we're normally going to compare them to previous years for the company, and also we'll compare them to what our competition in the same industry is doing as well, to see exactly how we're doing compared to our competition and what we've done in the past. Another common ratio is our accounts receivable turnover. And what this measures is how often do our receivables turn over in a year. So we measure this as our net sales divided by our average accounts receivable. Now remember, anytime you see average anything, you take the beginning of year balance plus the end of year balance and divide by 2. So we would do that for accounts receivable in this case. Generally, a higher number for this is better. This indicates that our receivables are turning over faster, and what turnover means is that we're selling, collecting, selling, collecting. The faster this happens, obviously, the better. In the next category, we have ratios that in general measure our ability to satisfy our long-term debt. And one of the more common ones is called our debt ratio. This is our total liabilities divided by our total assets. You can get both of those numbers off of our balance sheet. What this tells us is, of our assets, how much of that is funded by liabilities. We'll generally come up with a percentage for this, or this number will be a percentage. If it's a decimal like 0.4, we'd have to convert it to 40%. So this means how much of our assets are funded with debt. Generally, we like a lower number for this. These ratios down in this section are going to measure our profitability. One of the most common ones is our profit margin ratio, and this measures our net income divided by our net sales. So this tells us, of every sales dollar we have, what percentage of that do we turn into net income? Obviously, the higher, the better. We could be generating sales but not generating income, which means that we've got too many expenses. Return on assets down below here is a similar measure, but this measures how well do we take our assets and convert those into income. Again, anytime we're going to see net income in the numerator of a fraction, like here and like here, we're going to want a higher number. What's good enough for us? Generally, we're going to have to compare to what we've done in the past and also to what our competition has done. We're not really going to get into the stock price and dividend ratios, but these are here for your information.